Okay, and you remember that we said last time that assets equal liabilities plus stockholders' equity. And we had said at that time that assets had future economic benefit, right? So cash is an asset. If we have some sort of receivable that we're going to be getting in the future, that is going to be an asset for us, right? Future economic benefit. A building has future economic benefit because we're going to be able to use that into the foreseeable future. So all of these items are assets because they have what? Future economic benefit, right? Okay. Now you go over to the next slide here and you see that we have our liabilities. And remember that we said our liabilities are like our bills. Okay, so our liabilities are like our bills, right? And we had that little example with the lemon tree, and the guy didn't charge us for the fertilizer. He said, pay us a little bit later. And so that was a bill. That was a claim against our assets, right? Because we were going to have to sacrifice our cash later to pay that $17 bill or $7 bill, whatever it was. Okay, so our liabilities are like our bills. And then what? Whatever we have left after we have paid our bills is considered our stockholders' equity. That's our ownership in the company, right? And that's typically going to be what? Our common stock. And if we have retained earnings, and remember when we had earnings, we closed those out and put those into our retained earnings. And then if there were any dividends that we had to pay out, we would pay those out of our retained earnings. If you pay a dividend to a stockholder, you're not retaining that earning. You're doing what? You're paying it out to that stockholder, right? You're distributing it. That's right. Okay. So assets equal liabilities plus stockholders' equity. Then we came over and we took a look at this slide, and we just want to review that our stockholders' equity is going to be increased by our revenue, but then if we have expenses, our expenses will be subtracted off of our revenue to determine our net income. Net income gets closed into our stockholders' equity, right? Okay. And so we will have our revenues increasing stockholders' equity, expenses decrease it because revenue minus expenses is net income. Net income is going to increase our retained earnings, right? If we have an investment by our stockholder, that investment by our stockholder is going to what? Is going to increase our stockholders' equity. That's pretty obvious. And guys, I'm going to put my collar up, not because I'm trying to be Elvis, but because this thing is irritating my neck here. So if it looks like I'm trying to be cool or something, it's just because this thing is bugging me, okay? And so you're like, John, there's no way you could look cool, so don't worry about it, right? Okay. So what happens? We sit here and we have our what? Investments by owners. That's obviously going to increase our stockholders' equity. And then what? And then we have our dividends. If we distribute to our stockholders, that's coming out of our retained earnings. That's going to reduce our stockholders' equity, right? Any question on that? Okay. All right, good. So let's go ahead then and take a look at this exercise. And what we're going to do is go through and see if we can determine how each one of these transactions will affect these different accounts. Okay. And I had suggested that you put your this slide in what do you call it, slideshow mode, and just sort of go through it the way we're going to do here, but we're going to practice with this here. And so let's just go ahead and take a look. And we say that Ray and Barbara decide to open a computer programming service, and they're going to open this and invest $15,000 cash in common stock. So if I invest cash, is that going to increase my cash, decrease my cash, what? Well, it's going to increase. That formula has to stay in balance. It has to stay in balance that assets will equal liabilities plus stockholders' equity. So if you want to increase the equity, like you're saying, what was your name, sir? Dennis. So if we're going to increase equity, we're also going to have to increase an asset. We're going to increase cash, right? Okay, so that's sure enough what happens here. That transaction increases my cash. It increases my common stock, doesn't it? Okay. Okay, good. Now we come over and we take a look at the next transaction, and they say that they're going to purchase equipment for cash of $7,000. If you're going to purchase equipment for cash, what is that going to do to your cash? What do you think, sir? What's that going to do to the cash if you sit there and you spend cash? It's going to decrease the cash, right? Okay, so our assets are going to go down, which means that what? Either we're going to have another asset go up, or we're going to have a liability go up, or our stockholders' equity is going to have to what? Our liabilities are going to have to go up, or our stockholders' equity is going to have to go up. Come down, I should say, or our liabilities are going to have to come down. One of those, which is it? We're doing what? We're switching one asset for another. We're switching cash for our equipment, right? So we go ahead and our cash decreases, our equipment increases, right? Okay. Okay, good. Let's take a look at this next one now. And for this next one, they purchase $1,600 of computer paper, and they consider it a supply. Now, look, I think it would be a little too, anal of them to keep track of paper by setting it up as an asset and then using it. But let's just humor the question here. And so since they're saying that these supplies are going to be used in the future, they're going to be an asset, right? Okay, so what are we going to do? We're going to increase our asset, and they say that they're going to what? They're going to purchase it for cash, $1,600. Okay, I guess it's cash, so we're going to have to reduce the cash, right? Okay, so we go ahead and, okay, well, I looked and I didn't see that it said cash. Software, computer paper. Oh, where does it say on credit? Oh, right in the very beginning. Hello. So it says on credit in the very beginning. So if it's on credit, that's going to be a bill. It's going to increase my liabilities, right? Okay. Okay, good. All right, let's go ahead and take a look at this next one. And we received $1,200 from customers for programming services. So we provided a service. This is how the company generates revenue, right? And so what's going to happen? It's going to be cash that they're going to provide. So obviously cash is going to go up. We know that either our liability has to go up, or our what? Our stockholders' equity through revenue has to go up. What's it going to be? Our stockholders' equity is going to go up because our revenue is going to go up. We have earned a revenue, haven't we? Notice everything we do here is keeping this equation in balance. Assets equal liabilities plus stockholders' equity, and those are reported on the balance sheet. But what? We have our revenues, our expenses that are reported on the income statement. They're ultimately going to affect my retained earnings, thus they affect my stockholders' equity, right? Okay. Okay, good. We come over and we take a look at this next one, and we receive a bill of $250 for advertising, but we postpone payment until later. So if we have a bill for advertising, are our liabilities going to go up? Our liabilities going to go up? Okay, our liabilities are going to go up. Now, it's either going to have to be something else that's going to come down on this side of the equation, our stockholders' equity, or we're going to have an asset that's going to go up. Which is it going to be? Our expenses are going to do what? They're going to go up, which means that my stockholders' equity is what? Going to go down, right? Okay, so by increasing my expenses here, I decrease my stockholders' equity for this 250. So that's why they're showing that as a subtract. Even though my expenses are going up, my stockholders' equity is coming down. The equation is staying in balance, isn't it? Expenses reduce my stockholders' equity by reducing my retained earnings. Revenues increase my stockholders' equity by increasing my retained earnings. All right, good. Take a look, and we say that we provided $3,500 of program services for customer. We receive $1,500 up front, and we bill the customer for the rest. So we know we're going to have revenue here of what? $3,500 because we provided this revenue service again. So what's going to happen? Stockholders' equity is going to come up $3,500. We know that through the revenue. So we know that we're going to have our assets come up by that same amount, right? Which assets are going to come up? Well, obviously cash is going to come up $1,500, but we're also going to have an increase of our accounts receivable. Good, because we're going to be receiving that money in the future, right? And so sure enough, that's what happens here. Our cash goes up $1,500, our account receivable goes up $2,000, and there's our increase in revenue. Okay? All right, good. Let's go ahead and let's take a look at this next one now, number 7, and they tell us that we are paying the expenses, and we're going to pay store rent of $600, salaries of $9, and utilities of $2, and we're paying them in cash, aren't we? So the cash is going to go down by the total of these, and then our expenses are going to go up for these items, aren't they? Okay, so let's just go ahead and take a look, and they sort of do the expenses one at a time here, guys. It gets a little confusing. The cash comes down all at once, and now they're going to do each expense. Okay, and so there's the expenses, the utility expense, the salaries and wage expense, the rent expense. They have all three of those there. Those have increased my expenses, therefore my stockholders' equity has decreased, hasn't it? Okay, good. Let's go ahead. Let's take a look at this number 8, and we pay $250 on an account payable. So we're going to pay a bill. If you pay a bill, the bill decreases, doesn't it? You're going to pay this liability, and you're going to use your cash, so your cash is going to decrease. So this thing is going to stay in order here, where we decreased our cash, we decreased our liability. Okay, number 8, we received $600 in cash from a customer who had been billed for service. So we had a receivable, and now we have received that cash. So the cash is going to go up. The receivable is going to come down to keep the equation in balance. Assets equal liabilities plus stockholders' equity. Okay. All right, good. And then finally, we have this last one. Dividends are paid out, and we pay a cash dividend. That's going to decrease our cash for $1,300 and do what? Decrease our stockholders' equity, our retained earnings, because if we're paying a dividend, we are no longer retaining that earning. We're paying it out, right? Okay, and so sure enough, that's what happens with that one. Okay, so that's a pretty good little exercise, and like I said, you could practice with that, and you probably saw some homework questions where they were showing different transactions and asking you how the effect on the accounting equation assets equal liabilities plus stockholders' equity. Okay, so let's go ahead then and let's take a look at now the next slide, okay, and we will have 4 financial statements that we will talk about in this class: a balance sheet, an income statement. Balance sheet is going to report our assets, our liabilities, our stockholders' equity. Our income statement is going to show our revenues, our expenses, our net income, which then get closed out to the balance sheet onto retained earnings and through our retained earnings. And then we will also have statement of cash flows. At this point, guys, you just need to know that there's a statement of cash flows. In one of the earlier exams, they had a question on statement of cash flows, and I kind of talked them out of taking that off of the exam for the first exam, because we can deal with statement of cash flows finally in chapter 12. So we'll get to that later. Just know that it's there. We don't have to understand a whole lot of detail about that at this point. Okay, so what do we have? We have our revenues and expenses on our income statement. Difference between revenue and expenses is net income. We take our net income and we close it out to our retained earnings, and our retained earnings gets reported where? Retained earnings are not dividends. Retained earnings are the mother of dividends, okay, because eventually what? We will pay out retained earnings, pay out dividends out of our retained earnings, right? But retained earnings is the account name before we actually go ahead and close it out. I'm going to close that door because that glare is bothering the screen there. Okay. All right, good. So let's just go ahead and take a look at the next slide, and you can see how our retained earnings got closed into our our net income got closed into our retained earnings, I think I should say. And then the statement of cash flows, at this point, just know that the statement of cash flows exist. That's all we need to worry about. Okay. Remember, we talked about a couple things. Our historical cost principle. We record our items at cost. Remember, we said we bought a piece of land here in Fremont, 1974, whatever year I made up there. We maybe paid $100,000 for it, even though it's worth $1 million now. We still carry it at the historical cost, right? Okay. Then what? Fair value is if we were recording an asset at its fair value. If it's something like a fixed asset like land and its fair value has fallen below its historical cost, rule of conservatism says we will write it down to that lower fair value. So I don't know if they found nuclear waste on the land or something, nobody wants to pay $100,000 even for it, then we would have to write it down to its lower fair value, right? We do not write fixed assets like land up above their historical cost, right? Okay, but if they fall below their historical cost, we will go ahead and write them at fair value. Okay, revenue recognition principle is what we use to recognize our revenue. Typically, right? I mean, that's sort of like, can you read, right? Revenue recognition principle is what you use to recognize revenue. If I give you a question like that on the exam, you should probably be able to get that one right. Okay. Usually we recognize revenue when we earn it, okay? Expense recognition principle determines when we will recognize our expenses. It's pretty much when they are incurred. And then full disclosure means that we will record all circumstances that affect the company. For example, if the company is having a lawsuit, is subject to a lawsuit, and we're at the end of the year and we don't know what the outcome of that lawsuit is, the accounting standards still require that we disclose information about that lawsuit so the users of the financial statements can get a sense of what is the probability of an unfavorable outcome. What is the probability of an unlikely outcome? It's unlikely, right? What is the probability of a what? Unfavorable outcome? They would want to obviously know that if they're thinking about investing in the company's stock, right?
Or give them credit.
Give them credit for?
If they're looking for credit and they might have some future liability coming down, then
that's correct.
Factor into it.
Investors and creditors are external users. We're going to think about both of them, right? Okay. Okay, good. And they're our primary users. We have secondary users, but FASB, remember the Financial Accounting Standards Board, the entity that writes the accounting standards, says that we don't need to worry as much about secondary users, you think, thus the term secondary. So we have our primary users. We have our, I don't even think they call them secondary users. They're not primary, though. For example, regulators are considered not to be a primary user of the financial statements. So the IRS may use a company's financial statements in determining the appropriate taxes have been paid, but as far as FASB is concerned, they are not a primary user. Our primary users are what? Investors and creditors. Okay, they're the ones that we really think about when we prepare the financial statement. Okay, when we're providing information, when FASB is deciding to require a company to provide information, they ask themselves, does the benefit to the user outweigh the cost to the company providing this information? If they determine that the cost to the company to provide the information is more than the benefit to the user, FASB is not going to make the companies provide that information, right? So they do a cost-benefit analysis when they decide to ask companies to when they tell companies to include information in their financial statements, right? They don't really ask them. They may get comment from them, but ultimately they're going to make a decision of what needs to be included, and they only ask the companies to include information in which the benefit to the user will be more than the cost to the company to provide that information. Okay, these should look familiar, guys. These are the quiz questions. Okay, I went ahead and put them on the slides, and I think I'm going to go forward, maybe starting with chapter 2. Probably not, because we're going to do it tonight. So maybe starting with chapter 3, I'm going to start to try to embed the questions in the slides so that you can see the connection between what we're talking about and the quiz questions. I think that'll facilitate your study a little bit so that you can see, okay, here's 4 or 5 slides, here's 4 or 5 questions that go along with those particular slides rather than having to try to match it up after. I will still leave the Word file on there. So I'll continue to place the Word file with the quiz on there. And what I recommend you do is take the quiz and sort of clean it out so that it doesn't show the answers aren't highlighted anymore. And then you can work it as though you were working in the exam in class without knowing the answers, right? And then as we get closer to the exam, we'll do a practice exam in which I'll put some more questions up from the chapters for you to practice with. But anyway, let's go ahead. Let's take a look at these the way they were sort of pretty much laid out in the homework file that was sitting on Canvas. And we say under Chapter 1 is the practice quiz. And we say, which of the following is not an external user of accounting information? Regulatory agencies, customers, investors, all of these entities are what? External to the company, right? So they're all considered external users, okay? Which of the following is a primary user? And I already tipped you off on this one. Investors and creditors are our primary users, right? These other entities, SEC is a regulatory entity, IRS is a regulatory entity, GASB, I'm used to talking about governmental accounting all the time. FASB, the Financial Accounting Standards Board. The entity that writes accounting standards for state and local governments is called the Government Accounting Standards Board, the GASB. So you got the GASB, you got the FASB. So if I ever say GASB in this class, I mean FASB, okay? But the Financial Accounting Standards Board tells us that the primary users are what? Are creditors here, right? Investors and creditors. Okay, good. Number 3, in order to increase comparability, in recent years, the FASB, Financial Accounting Standards Board, and the International Accounting Standards Board have moved to an approach of convergence. What they do is they try to work off of the same general principles. They call it the conceptual framework. And they're hoping that if they're both working off the same general principles, then the resulting standards should start to converge over time. Okay, now, as I told you last time, they're like that couple that you say, oh, they're back together again. Oh, they're fighting again, right? So they have their moments where they're getting along, other moments where they're not getting along. But overall, they're trying to get together. We call that what? We call that convergence. That process is convergence. Okay, okay. Come over, take a look at number 4 here from your quiz. Liabilities of a company would not include, and liabilities are your bills. Cash is obviously not a liability. These other 3 would fall into the category of a bill, right? Okay, okay, good. Number 5. The origins of accounting are generally attributable to the works of, did I talk about this?
No.
Pacioli. Okay.
Okay.
Yeah, Christopher Columbus, Abner Doubleday, Leonardo da Vinci. I don't know. I mean, maybe da Vinci could have said something about it. Okay, he was a man, Renaissance man. Look, they talk about this Luca Pacioli. Okay, and what he was a 12th century Catholic priest living in Venice, and they say sometimes that he's the father of accounting. Get it? He was a padre, you know, the father of accounting, and they say that he invented accounting. He didn't invent accounting. I mean, that's sort of like saying I invented paper clips, okay? You know, accounting was a tool that was being used by business people at the time, and Pacioli wrote about that in his journals. Okay, and there were a lot of different things that he wrote about in his journals that were going on in 12th century Venice, and he wrote about double entry bookkeeping, and we're going to be talking about double entry bookkeeping here in a little while. The most important takeaway is that this stuff has been around since the 12th century. What you're learning in this class has been around since the 12th century. Can you think of any other system that has lasted since the 12th century? Not that many. So what does that tell you if it's been around since the 12th century? That it works and that it is relatively easy to understand and use, right? If it was something that was that much more difficult to use, we would have changed it by now. And I think I mentioned that last time a little bit, right? Okay, but Pacioli is the one that sort of wrote about accounting in the beginning. Okay, all right. So let's take a look at this next one. Martin Corporation purchased land in 2007 for $299,000. In 2013, it purchased nearly identical parcel of land for $460,000. In its 2013 balance sheet, Martin valued these two parcels of land at a combined value of $920,000. That must be $460,000 plus $460,000. Is that what you're supposed to do? No. That original land's got to stay at the historical cost. The new land's now historical cost is the $460,000, right? Okay, so that is what? That is a violation of the cost principle. Okay, all right, good. Let's go ahead and let's take a look at number 7. And number 7 tells us that the private sector organization involved in developing accounting principles is the FASB, Financial Accounting Standards Board. Who's holding FASB's chain? Good. Security Exchange Commission, if you look at the 3334 securities law, Security Exchange Commission had the authority to set accounting standards. They delegated that to the private sector, and the FASB was not the first organization. They had the Committee on Accounting Procedure, which was part of the American Institute of Certified Public Accountants. Then they had the Accounting Principles Board. That was part of the AICPA. And then in 1973, they decided to, though they didn't decide, there was a committee that was put together called the Wheat Committee, and the Wheat Committee looked and saw that there were certain conflicts of interest by having the American Institute of Certified Public Accountants being the entity that set the accounting standards, and so they recommended that we set up a private not-for-profit organization called the Financial Accounting Standards Board, and it was ripped away from the AICPA. Now the AICPA acts like the American Institute of Public Accountants acts like doves flew and the skies opened up and rainbows came forward and puppy dogs sang the day that they gave up the accounting standard setting process. They were very reluctant to give it up, and but they did, and FASB took it over, and FASB has been the accounting standard setter since that time, since 1973. Okay, good. Liabilities of a company would not include, and be careful with my exams, guys. I throw that not word in there and it can mess you up, and if you think you know the answer after reading the first choice, always read through all three, because a lot of times you'll say, this question doesn't make any sense, and that's when you look up and you see the not. Okay, so it's important to know your knots, all right, or recognize your knots. And so we have what? We have liabilities of a company would not include. Cash is not a liability, it's an asset, right? All the rest of these are payables, they are bills. Okay? All right, good. Number 9, Andre Dickinson, owner of Andre's Fine Wines, also has a personal residence that costs $475,000. The market value of his residence is $625,000. During the preparation of the financial statements, the accounting concept most relevant to the presentation of Andre's home is the economic entity concept, right? We keep the personal assets of the owners separate from the productive assets of the business, right? Okay, good. Economic entity principle. Yes, sir. Okay. Let's go ahead and let's take a look at number 10. Okay, thank you. That's fine. It's all right. If I do that on the test, make sure you pick the same answer each time. Or if you don't know the answer, diversify and choose 2 different ones, right? Okay, maybe you'll get it. But if you're just guessing, you might as well, take a shot at 2 different answers. Okay, but thank you. I'll do that sometimes. Sometimes I use that little snipper thing, and I forget what I did with it in the previous ones, and I'll repaste something that I thought I got rid of. Anyway, let's go ahead. Let's take a look at this one. The cost principle requires that when assets are acquired, they're recorded at what? At their cost. Okay. The Deuce Company has 5 plants nationwide that cost a total of $100 million. The current fair value of the plants is $500 million. What should the plants be recorded at? 100 million. I mean, the accountants are kind of, you know, these people that you keep asking them the different question and they keep giving you the same answer, don't they? It's got to be what? Got to be historical cost. Okay? Okay, good. Number 12, the economic entity assumption requires that activities of an entity be kept separate from the activities of the owner, right? And we've seen that now a couple times. Okay, coming over to the next question, number 13. A small neighborhood barber shop that is operated by its owner would probably be a sole proprietorship. And we talked about that a little bit last time, the different forms of business. Sole proprietorship is typically a small business. As you get to larger scale businesses, they tend to incorporate, and that's when we really have the separation of ownership and management of the company, and that's when our financial reporting becomes much more critical. Okay. Okay, owner's equity is best depicted, and they're playing jazz with the accounting formula here a little bit. We know it's assets equal liabilities plus stockholders' equity, but by definition, if you did what? You moved it around a little bit and said assets minus liabilities, then the difference that's left over would be stockholders' equity, right? Just think of it, if your only asset was cash, you had $100 cash, but you had a $20 bill you had to pay, then really only $80 of that cash is what you own. The $20 got to go to the PG&E company or whatever, right? Okay. Okay, good. 15. Here's a tough one. No, not highlighted. 15. A future is a future economic benefit? No. After existing debts and obligations? Sounds right to me. Possess service potential. I think that's an asset, right? We can use that to potentially provide some service, or things of value used by the business. That's an asset, right? So 3 of these are assets, and the definition of assets, and only B constitutes the definition of a liability. Okay, good. Let's start to get some numbers around this thing. Okay, and so what do we have for number 16? The accounting equation for this quattro is assets equal 120,000, liabilities equal 60, and stockholders' equity, equals 60. So this thing's in balance, isn't it? And it's got to stay in balance. And this is like that little exercise where if you purchase office equipment for 15,000 you purchase it on account, what's going to happen? Your assets will go up 15,000, but your liabilities will go up 15,000, won't they? Okay, so the assets become 135, the liabilities become 75,000. This thing still stays in check, doesn't it? Still stays in balance? Okay. Okay, good. A balance sheet shows what? Assets, liabilities, stockholders' equity, right? Okay. Okay, good. Number 18, an income statement does what? Presents revenues and expenses. And we say for a specific period of time, your income statement, guys, goes from January 1st, assuming you have a calendar year as your business year, not a fiscal year. Calendar year goes from January 1st to December 31st. Fiscal years go different months over a 12-month period. So you could have from July 1st to June 30th being a fiscal year, right? But in this class, we'll deal with calendar years, and so we have calendar years, and your income statement covers from January 1st to December 31st. It shows you the results of operations for that year. Think of your income statement as your last paycheck of the year, where you sit there and you look, and for the last paycheck of the year, you know how they give you the year-to-date earnings, whatever, and you look at that year-to-date, it runs at the beginning of the year, it's 0, and then it runs, and by the end of the year, it's whatever amount you made for the whole year. We do that with our income statement, and then we have, of course, our expenses that we've taken track of all year. Revenues minus expenses is going to be my net income. That's just for that year, right? So what would my revenues be at the start of January 1st? 0 again. Good, right? That goes back to 0. Your balance sheet is like your wallet. Your balance sheet is like your wallet. If you have $100 cash in your wallet when you go to sleep on December 31st, you wake up January 1st, how much money is in your wallet? Well, unless you went wild that night and you don't know where your wallet is, there should be what? There should be that same $100 sitting in your wallet that next day, right? So the balance sheet is like your balance, like your wallet. So whatever was in your wallet at December 31st, whatever on your balance sheet at December 31st, will still be there at January 1st of the next year, right? Yes, sir. The balance sheet will keep track of everything at all times, and everything rolls forward from year 1 to year 2, from year 2 to year 3. And our little in-class example today, I'm going to show you how that looks on the on our ledgers, and we'll talk about ledgers here in a little while. Okay, question on any of these? Oh, okay. How about this one? Okay, let's take a look, and they want us to tell them which of these are assets. Okay, we got to be able to figure out which of these items that are reported here on this problem are, what do they want to know? Are assets. Okay, so let's just go ahead and I'll highlight in yellow the assets. Is revenue an asset? No, revenue is revenue. Revenue is reported on the income statement. It is not an asset. It'll increase my stockholders' equity, but it's not an asset, right? It's a revenue. Okay. Okay, good. How about my retained earnings? Retained earnings is equity, isn't it? Right? How about my equipment? Does equipment have future economic benefit? Yes, it does. So it is going to be an asset. So equipment's going to be included. Good. How about expenses? No, those are on the income statement. They're expenses, right? How about cash? Cash has future economic benefit. In fact, that's my favorite asset. I don't know about you, but I like cash, right? Okay. All right, good. How about dividends? Dividends are going to be paid out of my retained earnings, so they affect what? They affect equity, don't they? How about supplies? Yes, supplies is an asset. It has future economic benefit. I mean, you know, I think it's a little annoying to keep track of paper the way they were talking about in that question. I don't know that a company would actually do that, but what? But technically something like a supply is an asset, right? Okay. Okay, good. How about accounts payable? No, that's a liability, right? Okay. How about accounts receivable? Yep. Okay, good. So if you add those up, I hope you get this number. I've got some explaining to do, right? Okay, are you bringing your calculator, guys? You need to bring your calculator to this class. This God-made calculators for our Business 101A and B. So when you take those classes, you want to have your calculator ready, right? Okay. Okay, good. Any question on that one? Okay, good. Let's go ahead and let's take a look at this one. And now they want to give us the same information, stockholders' equity. If I had known that, we could have gone through and called out our stockholders' equity on the previous page. But let's go ahead and just stick with this one, and we'll call out our stockholders' equity. How about in blue? Okay. And so how about revenues? Is that stockholders' equity? Revenue is what? Is revenue. Now it's going to affect stockholders' equity, but it's not stockholders' equity, right? Okay. How about my retained earnings? That's going to be stockholders' equity, and they're telling me my retained earnings. Oh, interesting. This is a really crazy question. Something's wrong with this question. If they want to know the stockholders' equity at 131, I think this needs to be 13. Okay, 131. There's a problem with this question. I think we want this to be 1231 what? 13. Okay, and they want to know the stockholders' equity, and so we're going to go ahead and pick up the common stock, aren't we? Pick up the common stock. That's 40,000. See if I know how to work this. And anything else here, stockholders' equity? I said that. Common stock. Anything else is common stock is 40,000, right? Okay. How about the retained earnings? Okay, and what we're going to do with retained earnings is we're going to start with the beginning balance in retained earnings. The beginning balance in retained earnings is what? 30,000. And then we're going to go ahead and add our revenues. So let's just write revenues over here. Revenue is going to be what, 170,000? Okay, I see what they want us to do. 170,000. And then I guess I've got better start to take off some expenses. Okay, and so I'm going to go ahead and pick up my expenses now. And what, equipment's not an expense, it's an asset, right? How about expenses? Are those expenses? So we go ahead and we take off that 125,000. Anything else here expense-wise? Does not. Accounts payable is a liability. It's not an expense. That account payable could have been last year's expense, and I just haven't paid the bill off yet because that's going to roll forward into the next year, right? So even though that may have been from, I may have an account payable from an expense, it doesn't mean it's from this year, right? And if it is from this year, then it should have been included in this $125,000 expenses. Maybe some of our expenses were paid in cash. This one we haven't paid yet, right? If it did incur this year, that account payable, so no. Any other expenses? Dividends are not an expense. We pay them out of retained earnings, but they are reported on the statement of retained earnings. Right now, we're just trying to get to our net income, which is going to be our revenues minus our expenses, right? Okay, so when we take our revenues minus our expenses, that gives us what? NI is net income. What's the difference here? 45,000. Okay, good. So there's 45,000. Okay, we don't want that to. We don't want our revenue to disappear like that. So we got 45,000, our income, I should say. 45,000. Okay, good. Anything else affecting my retained earnings? Anything else affecting my retained earnings? Good. I pay the dividend out of retained earning because if I'm paying a dividend, I'm what? I'm not retaining that earning. I'm paying it out, right? So what's that? Dividends were 10,000, so that's a subtracted 10,000. Okay, good. So what's the ending balance then in my retained earnings? 30 plus 45 is 75. What's that? 65,000? 45, 75 minus 10 is 65,000. Okay, and so 65,000 plus what? Plus the common stock of 40,000 should be my stockholders' equity. Is that the right answer? 105,000? Oh, I didn't give you the answer to this one? Good. Okay. Question? Okay, so revenues minus expenses, net income. Net income goes into my retained earnings. That's my earnings. I will retain it, right? Until I don't retain it, I pay it out as a dividend, so that's a subtract from my retained earnings. And my common stock, my stockholders' equity is what? Common stock plus my retained earnings, right? Question? Okay, good. You're going to see questions like that on your midterm, I promise. Question? Okay. Okay, good. This will be a piece of cake for you by the time you're getting to the questions on the midterm. Okay, I think